Have you ever wondered what makes a real estate market suddenly boom with activity? Welcome to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. Let's get right to it. Bob Francis of the Fort Worth Report highlights a recent development in the Fort Worth Stockyards real estate market, which is showing promising signs of growth. A group of seasoned investors has recently acquired a prime piece of commercial real estate in an all-cash deal, closing in just 3 weeks. This acquisition enhances their holdings in one of the city's most popular tourist destinations. The new asset, a 4,650 square foot store located at 2405 North Main Street, is net leased long-term to Boot Barn Incorporated. Todd Lambeth, Executive Vice President and Managing Partner at Bradford Commercial Real Estate Services, represented the buyer, Stockyards BBLLC. Lambeth noted the competitive nature of the area, stating, "We swooped in under the radar with an attractive price." The seller, represented by Daniel Poku and Sabrina Sapienza of SRS Real Estate Partners, was TEH Fort Worth LLC, a longtime operator of a Western wear shop at the location. The property, originally built in 1916 and recently renovated, sits on a 0.2-acre tract in a destination drawing over 10 million visitors annually. Boot Barn, a publicly traded company with 412 stores across 46 states, had been eyeing a Stockyards location for some time. They inked a 10-year net lease with renewal options for this highly sought-after site, nestled among attractions like downtown Cowtown at the Isis and the Stockyards Saloon. This transaction coincides with Yellowstone and Landman creator Taylor Sheridan's announcement of his investment in the iconic Cattleman Steakhouse, further enhancing the area's appeal. As we see, the Stockyards is not only a hub of cultural and historical significance, but also a thriving real estate market. TRD staff reports that distressed commercial real estate debt in Texas has reached $500 million, with much of this debt tied to multifamily properties. These properties were acquired between 2021 and 2023 during a surge of investor interest in the state. Buyers intended to renovate and flip these value-add apartment complexes for profit, but rising interest rates and declining property values have disrupted these plans. Houston's Harris County is at the center of this crisis, with 9 properties representing $267 million of debt headed to foreclosure. However, no metro area in Texas has been spared from this trend. Billionaire Charles Cohen is facing foreclosure on the Decorative Center Houston after allegedly defaulting on a $50 million loan from Ladder Capital. This potential foreclosure adds to Cohen's financial difficulties, which include a $534 million loan default and a $187 million personal guarantee judgment. In Austin, multifamily syndicator Alan Stalcup is under pressure from Starwood, which has sued him for allegedly breaching recourse guarantees on 3 properties in Orlando, Atlanta, and Nashville. Stalcup could be liable for $110 million. Meanwhile, former bank OZK executive Dan Thomas is launching Forestway Capital in Dallas with $200 million in initial commitments. His firm aims to invest across asset classes in the Sun Belt using a patient and disciplined approach. They plan to target note acquisitions, mezzanine loans, and preferred equity deals. Blue Diamond Growers' recent announcement to close its long-standing Sacramento plant has sparked significant interest from a real estate angle. This facility, which has been a staple of the region's agricultural legacy for over a century, is set to cease operations and relocate within the next 2 years. Local officials and industry experts see this as an opportunity for substantial real estate development in the area. The plant's closure opens up a prime piece of real estate that could be repurposed for various commercial uses. Given its historical significance and strategic location, potential developers are eyeing the site for projects that could range from multifamily residential developments to retail and office spaces. The possibilities are vast, and this transition could lead to a revitalization of the surrounding areas, attracting new businesses and residents alike. In a similar vein, the Kitchener-Waterloo region in Ontario has seen comparable opportunities arise from the repurposing of industrial sites. The transformation of these spaces into vibrant mixed-use developments has not only preserved historical elements, but also energized local economies. This cross-border relevance highlights the potential benefits of such real estate transitions. offering insights into how former industrial sites can be leveraged for modern commercial applications. As we examine the American perspective, the Sacramento plant's closure and potential redevelopment echo broader trends in the United States, where former industrial sites are increasingly being transformed into mixed-use developments. This shift not only maximizes the value of underutilized properties, but also aligns with urban renewal initiatives that prioritize sustainability and community engagement. Despite a downturn in the downtown St. Paul office market, some companies are finding new opportunities for growth. FreezePack Logistics, a New Jersey-based cold storage and food delivery company, recently expanded its operations by signing a long-term lease at Commons. The 6,500 square foot space near the top level of the 13-story office building on St. Peter Street will nearly triple their workspace. Mo Shearer, FreezePack's Senior Vice President of Transportation, highlighted the influx of applicants from the Twin Cities, which influenced the decision to expand locally rather than on the East Coast. Similarly, the Jacobson Law Group is relocating its 16 attorneys from the Great Northern Building in Lowertown to a 7,400 square foot space at Commons. The move comes as the office building seeks to rebuild its occupancy levels, which had dropped significantly due to the pandemic and the shift towards remote work. Jerry Hersman, Vice President with Frauenschuh Property Management, noted that while Commons has not returned to pre-pandemic occupancy levels, the building is stabilizing and growing. The reshuffling of commercial tenants within downtown St. Paul is seen by some as simply shifting the deck chairs, yet it presents an opportunity for growth. As state government and other employers require more in-person work, downtown St. Paul could see a revitalization. The city has launched a space use study to explore consolidating its downtown offices, potentially leading to the conversion of some office spaces into residential units. This trend of office-to-residential conversions mirrors developments in Kitchener-Waterloo, Ontario, where former industrial sites have been transformed into vibrant mixed-use communities. These projects have not only preserved historical elements, but also boosted local economies by attracting new businesses and residents. In the United States, the trend is also gaining momentum, with properties like the landmark towers in St. Paul being converted into luxury housing. Such conversions maximize the value of underutilized properties and align with urban renewal initiatives. The transition of offices to residential spaces offers a promising solution to high vacancy rates in commercial real estate markets. The return of state employees to downtown St. Paul is viewed as a wild card that could impact future developments. With the state calling back thousands of employees, property managers remain hopeful for increased activity. However, the consolidation of state offices might limit the overall benefit, as some offices relocate outside of downtown proper. Ultimately, the revitalization of downtown St. Paul may depend on a combination of factors, including the return of state workers, the strategic relocation of businesses, and the successful conversion of office spaces into residential units. These efforts are aimed at creating a more vibrant and economically sustainable urban core, reflecting broader trends seen across North America. In the world of commercial real estate, closing a deal is often seen as the pinnacle of success. However, Alan Buchanan from the Orange County Register suggests that the true value of a deal is realized in what happens after the closing. Buchanan, a principal with Lee & Associates Commercial Real Estate Services, introduces the concept of expand as the final step in his sequence framework. This approach turns a successful transaction into an opportunity to build a great reputation. Sequence, Buchanan explains, stands for source, evaluate, qualify, under contract, execute, negotiate and close, and finally, expand. Each step builds upon the last, but it's the expand phase where many brokers fall short. Buchanan emphasizes that expanding is about more than just celebrating a closed deal. It's about sharing the story behind it. By doing so, brokers can increase their visibility, credibility, and connectivity within the industry. Visibility is achieved by crafting a narrative around the transaction. Instead of merely announcing a closed deal, Buchanan advises telling the story of the client, the challenges faced, and the solutions provided. Highlighting the client's success positions them as the hero of the story, with the broker as the guide. This approach not only showcases the broker's effectiveness, but also leaves a lasting impression on potential clients and industry peers. Credibility follows when brokers consistently share their closed deals, rather than just listings or market updates. Buchanan notes that this kind of third-party validation can lead to referrals and new business opportunities. Sharing the success stories of past clients in similar industries can resonate with prospects and build trust in the broker's capabilities. Connectivity is another crucial aspect of expansion. Every transaction involves multiple parties, including clients, other brokers, lenders, attorneys, and more. By staying connected and expressing gratitude through thank you notes or deal announcements, brokers can keep their network engaged and open doors to future business opportunities. Buchanan shares a real-world example where publicizing a deal led to inquiries from other owners in the same industry, ultimately resulting in a significant assignment. Buchanan's insights remind us that in commercial real estate, a closed deal is not the end, but rather the beginning of new opportunities. By focusing on expanding their network and sharing their successes, brokers can multiply the value of each transaction. As Buchanan puts it, your last deal is the beginning of your next opportunity. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.